10,000 rupee SIP for 20 years. If you do it in Nifty 50 and Nifty 100, here is the difference. In Nifty 50, you will make a return of 92 lakhs, and in Nifty 100, you will make a return of 98.5 lakhs. Now, that is a 6.5 lakh difference. But why is that the case? Both Nifty 50 and Nifty 100 are large cap companies. They are one of the largest players in India. But how is this difference happening? How do we position this? And if we are someone who is looking at investing long term in a large cap kind of a fund, then what are the different type of structures we need to look at? So that is what we're going to dive in this video. So stay tuned. Now let me quickly screen share and show you everything. If you look at Nifty 50, the 10-year CAGR of Nifty 50 is 11.2%. And if I look at Nifty 100, which is just another 50 companies after this, it is 11.5%. Now you will say, Shashank, that the difference between these two is 11.2 and 11.5. So isn't the difference just 0.5%, 0.3%? Isn't 0.3% very small? Maybe, possible. But let me show you something else. The CAGR on Nifty 50 is 8.98 in a 5-year time frame, and Nifty 100 in a 5-year time frame is 9.59. So it seems like in the last few years, Nifty 100 is outperforming Nifty 50. Now, this is why I'm telling you this is, a lot of people come and say, Shashank, we should do index fund investing. We should do ETF based investing, which is absolutely fine. There is no wrong statement saying you should not do index fund. Index fund is actually a very good way to start investing because most people don't even beat the index. But people don't choose the right index. Everyone, when you say index fund investing, they say Nifty 50 is the best way to go. We will find one Nifty 50 index fund. We will invest in that Nifty 50 index fund and we will keep adding on dips, which is a very good strategy. But you should also know that there are other better structures out there that you should look at. And only we will look at data, nothing else. Okay. Now, what is Nifty 100? If you look at Nifty 100, Nifty 100 is nothing but Nifty 50 plus the Nifty Next 50. Okay, Nifty Next 50 is nothing but the next 50 companies of Nifty. So if you look at Nifty 50 only, so let's look at the constituents of Nifty 50, you will see that it starts, let's say, with Reliance at 17 lakh crore market cap, and it ends at 50 with Tata Consumer at 1,9,500 crore market cap over here, right? So this is the difference between, this is Nifty 50. It ends at 1 lakh crore and Tata Consumer is the last company. If I go to Nifty Next 50, which is this one, here you will see that this starts at basically 4,33, and this goes down to 94,000, but the companies are quite different. Now, if I go to Nifty 100 as well, and I go to show you here, it starts with Reliance. As you remember, it starts with Reliance. But here we have a lot more companies, and if we go all the way down to the 100 company, it is Shree Cement sitting at 94,000. In fact, the company we saw, Tata Consumer, is the 90th company. After that, there are 10 more companies over here, and sometimes the constituents are slightly different. Now, as I said, where is the alpha coming from? Why is Nifty 100 outperforming Nifty 50? That is because of Nifty Next 50. Now, if you look at Nifty Next 50 over here, which is the next 50 companies of Nifty, you will see that the CAGR difference is insane. If you look at the 10-year CAGR, it is 13.3%. If you look at the 5-year CAGR, it is 13.4%. This is because we are seeing a trend in India in the last 5 years where the small, mid and next large companies are performing better than the large companies today. So the Nifty Next 50, which is the 50 companies after this, are performing better than the large cap index as well. And that is why you see this outperformance. But only problem with this, obviously, it's not that simple, right? And why investing only in Nifty Next 50 is also a problem is because this is more volatile, okay? Compared to Nifty 50 or Nifty 100, if I show you Nifty 100, which gives you the blends of both world, if you see the chart here, this chart is more structured as compared to the chart of Nifty Next 50 because here the volatility is higher, right? And usually in Indian market, people don't like so much volatility. They want a smoothened curve going up. They don't want too much up and down coming into the system. And that is why Nifty 100 gives you the blend of Nifty 50 and gives you the blend of Nifty Next 50. Now, sometimes this also happens, right? When the FII start coming into the market, they usually try to buy Nifty 50 companies first. They don't buy the Nifty Next 50. They don't buy mid. They don't buy small. Only after the FIIs are taken over most of the Nifty 50 companies, only then they start going lower for higher risk, higher alpha. Right? So for me, if I had to choose, let's say I want a large cap exposure, I would not take only Nifty 50. I would not take Nifty Next 50 only because I would still silo myself. But a good blend would be Nifty 100 and it still gives me better outperformance. Obviously gives me better outperformance than everything else. Now again, you might say that Shashank, 0.3% or 0.5% ka outperformance, how is it possible? That is because if I am investing for 10 years or 15 years or 20 years, usually when you invest for 20 years, that 0.5% or 0.7% that builds, that starts giving a lot of outperformance over a long period of time. And that is the blended advantage you are getting, because 0.5 to 0.7% advantage is crazy, compounded, provided you stay invested for a long period of time, right? And now I'll show you one more very interesting difference, right? So if you see the profit dominance, okay, let's understand profit dominance. Now, Nifty 100, this Nifty 100 that is there, this index that is so interesting, that 100 companies generate 70% of all companies' profits. So these 100 companies that you see currently provide 70% of all corporate profit on the exchange, right? The remaining companies, how many ever are there, they're only providing for the 30% of the pie. That means most of your growers, the wealth builders of the nation, is in this Nifty 100, right? So you need to understand all of these things as well, because data is the most important thing for us to learn. And again, this is a learning channel. So as long as you're learning these things, even I didn't know this when I was doing research about a good index to invest in, that is when even I found this as well, right? And it has been consistent throughout. So usually it is around 75%, like 75% of all the corporate income on the exchange comes from Nifty 100. Only 25% comes from the bottommost. That means a lot of concentration for India's growth story is here. Now you will keep saying India's growth story, we should invest. But India's growth story sadly is being concentrated in the Nifty 100, correct? Because 75% of all the growth, technical growth, is coming here. Yes, now there are companies that are highly valued, there are companies that are fairly valued, there are companies that are undervalued. All spectrums are there. You will see that the P ratios are high. Some places the P ratios are lower. For example, you can see Solar Industries at 100, 66 Pidilite, and there will be something much lower as well at, I mean, I won't go to PFC, but if you go much lower, you will see 15, 14, 13, 11. All of these are also there. So it is a blend of both. And a better way to look at it is you can just take a blended P ratio. But this also I would not say is the right way to look at it, because even here you have to remove X PSUs, because PSUs usually trade at a lower end, right? Even though their profit pools are high, they don't trade at a very high valuation. So that is basically how I would look at it. But profit dominance is crazy, because over the last decade, they have been sitting at 70 to 75% of entire profit pool that comes into the picture, right? Now, if you look at how we look at the risk, because again, risk is the most important when we look at anything, right? Both Nifty 50 and Nifty 100 carry a similar kind of risk, right? Nifty 100 will obviously carry a slightly higher kind of a risk. That is why the reward also becomes higher, but the risk definitely is higher. Why is the risk definitely higher? Because we say that Nifty 50 is the largest 50 companies of India. So if India has to grow, these companies have to grow, right? And then we say the next 50 companies, which is the Nifty 100, which has the next 50 companies, they might be more risky in a bad market. Their volatility will be higher in a bad market. They might fall higher in a bad market. So these are some things that are there. But this story, I believe personally, is changing a lot, because I look at the last 5 years data. I don't see Nifty 50 growing. The top 3 companies of Nifty 50 are all having individual problems with themselves, right? And I'm seeing a lot of new age companies that have entered the Nifty 100, a lot of hospital sector companies, a lot of pharmaceutical sector companies. They are coming and dominating the Nifty 100. That is what I am seeing. And that is why we are seeing a very good growth that is coming into this segment. And I'll show you something even more funny. If you look at Nifty's 1 year fall, Nifty 50's 1 year fall is around -5%, but Nifty 100's 1 year fall is only -3.53%. And this is actually ulta, right? Because Nifty 100 should fall more technically because it has higher risk, but it is not falling down as fast as Nifty 50 for 2 reasons. One, obviously Nifty 100's diversification is more because it's 100 stocks instead of a concentrated 50 stock basket. Second, Nifty 50's top players are only not performing, right? The junior team is performing better than the senior team. That's happening in real life also. But it looks like the A team is performing better than the main team. And that is basically what we are looking at, that the profitability is coming very fast from these smaller players and they are growing aggressively in this market. And that is why I like this, okay? Chalo, now I know a lot of people will ask me in the next question, okay Shashank, if we have to take exposure into Nifty 100, because we always used to take Nifty 50, how can you take exposure? So here I would say the best way to go through this is a simple mutual fund route, right? Don't overcomplicate things here. But as I said, you have to stay invested for 10, 15, 20 years. Only then it actually makes sense for you. And here I don't usually try to experiment with a lot of mutual funds. I know a lot of people experiment a lot of mutual funds. I prefer to just take the guy with the largest AUM, right? That is where most of the people are investing, and this is an index fund, so AUM has no problem here, right? So I would want someone who has a high AUM and low tracking error because he's an index fund. I want him to track the index as close to as possible, and I want low expense ratio. So let me show you something. I did my research. So there is one, I'll just go directly to the main website and show it to you. Again, please look at it only from a learning perspective. Okay, this is not a recommendation, just a learning perspective. So if you look at this is an index fund, simple direct growth, not regular. Regular is also there, but direct growth is also there. So I'll show you that. So this is a simple Axis Nifty 100 index fund. Okay, now Axis obviously is a very good company. They have around 1,966 crores under AUM. The age of this fund is also almost 7 years, and the expense ratio is 0.25. That means if I take this with a tracking error also, the expense ratio comes to around 0.25. That means if I see a 0.5 to 0.7% alpha being baked into Nifty 50 and Nifty 100, and I have to give 0.25 as my expense ratio, I would still make around 0.4 to 0.5. There's no other alternative, right? We still have to find some instrument, and every instrument has some kind of a expense ratio. So that is something we will, if you're investing, there is a cost to investing as well, right? NAV is currently at 22 right now. Okay, interesting. And CAGR returns versus benchmark returns. Okay, this is fine. Okay, so as you can see here, and this is how the fund has performed since inception. Let me see how the drawdown was COVID time. So before COVID, it was at 10 rupees. After COVID, it was 7.5 rupees. That means it has fallen around almost 30%, 25% approximately. And then after from 7.5, it has obviously gone up to 21 right now. Basically, this is basic compounding, simple compounding, that it has gone from 2020 to 2026. It's just basically doubled in five and a half years. But again, please understand, past performance has nothing to do with future performance, because you already know in the last 2 years we have not done much as well, right? But let's understand where the next 50, how the difference between Nifty 50 and Nifty Next 50 looks like from this perspective. So this has Nifty 50. There is no change that it does not have Nifty 50. It has Nifty 50. But let's look at the exposure that is there. One good thing is there is no exit load. Usually people have exit load. Big funds have exit load. This has no exit load, means you can enter and exit. You don't have to pay any extra amount for that. The SIP amount here has come to only 100 rupees, which is crazy. There's a daily systematic investment. There's a monthly systematic investment as well. So it's only 100 rupees. And you can look at it from any broker that you want, because it's a direct fund. So you can look at it from any broker that you want, right? Now, how do we look at, let's do some analysis here. Let's say 10,000 rupee SIP, okay? Let's say from the date it started, which is 2019, and till date, which is whatever this date is, and it has come to around 12 lakh 15,000. Invested amount is 8 lakh. Total returns is approximately 4 lakh for a large cap kind of a structure, right? This is also in the assumption that last 2 years, the growth has not come in because the market has been flat. But over a period of time, you will see the amount growing, because SIP obviously works in your basic favor, right? So this is how it is. Annualized return is here. Benchmark return is here. Nifty 50 is here. Nifty 100 is here. So you can see how the nice difference is coming in both. Every time, Nifty 50, Nifty 100, you can see very clearly that every time there is a 0.5% alpha, again almost 0.8% alpha in 5 years, almost a 1.5% alpha here, and even here it has not fallen down too much. So this is, I mean, see, our job is to look at multiple stuff. We are analysts. We'll sit and watch and analyze every single thing every single day. So we are trying to find the best funds for ourselves also, right? Not just for you, but we want to find it for ourselves. So this is what we basically do. So again, very interesting. But I would always say, before doing anything, please do your own research before investing, right? That is, I think, the most important and the most key thing to look at. That always do your own research before investing, right? Only good things here, I would say, the AUM is good. The tracking error here is 0.03%, which is very low. The expense ratio, as you can see, is anywhere between 0.21 to 0.25. That is the range we have noticed. And the SIP starts at 100 and it has no exit load. So that is one more good thing that is there, right? Now coming to the basic conclusion. Now, obviously, not everything is for everyone. We understand that. I know a lot of people who buy mutual funds also like stocks, which I don't understand why. They will have 15 mutual funds, 20 mutual funds. There is no reason for you to have so much. You basically have a limited universe basket, right? You need to be smart about how you play that basket. I know a lot of people just go buy Nifty 50 blindly. I know a lot of people buy Nifty Next 50 blindly. Then they say, why is the risk so high in Nifty Next 50? Nifty 50 is smoother. It is falling less. My Nifty Next 50 is falling more. So you have to understand how different instruments in the market work. There are people who go by thematic funds right at the top of the theme, which is again a very big problem. So you have to first look at what you want, how you want to invest, what your allocation should look like, and only then invest in the market, right? But again, this was just an educational video. I was just trying to show you the difference between Nifty 50, Nifty Next 50 and Nifty 100 from all three from a blended average perspective, right? Again, if you have any more doubts, any more questions, you can comment in the comment section below. And if you like this video, please click on that subscribe button because I'll keep coming out with more amazing videos like this. I know a lot of you guys like mutual funds, so I'll keep coming out with more interesting mutual fund video for you guys. Okay, awesome. Take care. See you guys. Bye-bye.